We're going to be talking a little bit about why things are what they are, and it has a lot at Swift, or if you're leasing your trucks, especially why they are the way they are to cover that gap.
And why the program that we have was built the way that it was built.
Let's start at the beginning.
Right.
So, traditional insurance, and there's people that did this with Mojave too. You call in once a year, and you get your payment reduced, your premium reduced, based on the new value of the truck at that time. Okay, that's a pretty standard thing with standard insurance. But that insurance, and this is where it gets a little muddled. And since we were confused, we thought y'all might be confused getting a call from Sandy today to backtrack on some stuff. Um, that's traditional trucking insurance with no gap.
Right.
Okay, this is one of the difference between having a program where you're part of a group and traditional insurance. So at Swift, the carrier, IEL demands gap insurance, and rightfully so. So we had to build an insurance program that covered the gap. So that's why that covering of the gap is why we can't lower our rates every year like you might be used to. So what it is they've taken what the average premium would be over 3 years. Typically, you have a truck for about 3 or 4 years, and say, okay, this is the rate, 4% or whatever it is right now. We didn't have an increase this year, so we should be right there in the low 4% for truck value.
Right.
So they took the average of what that was over the 3 years. So basically, that lowering of premium is already built into the rate for the entire 3 years. Okay. So you're basically front loading the money that you would have to pay at the end of the lease, at the beginning of the lease, to smooth out your payments over that lease period.
Right. Which overall still stays less
Right. We
than
ran numbers
elsewhere.
with Tony because we actually called Tony and called him out on this. Hey, man, this isn't what we're used to. You need to explain it. And
Right.
now it took 2 hours, but he did trying to condense this into a shorter segment. Um, but that's the bottom line. So no, we cannot call in and have our rates reduced until we pay the truck off. But when you pay the truck off, you don't need gap anymore. It just you figure out what the value of your truck is and you get insured for that amount.
Right. So keep in mind that in the event of a total loss, right, the insurance pays for the Swift guys, will pay the entire owed value on the truck. Okay.
Yes.
So
So
insurance typically pays to market value. We'll use my truck as an example because I know the numbers on it right now because I really went over them deep today. The only number I'm not positive on is my SLV right now. We can say it's either 132,000 or 137,000. It's one of those two numbers. So we're going to work with that. So today my truck is, let's call it $137,000. If you look at like kind trucks on truck paper, which is basically how every insurance company they use that to figure out the market value of a truck, because truck paper has like the biggest repository of info on that. And that's basically where they calculate the market value. They take the average price for a like kind truck, same specs, mileage, the whole 9 yards. So my truck on truck paper right now with 350,000 miles on it is about $91,000 in the market. Now, keeping in mind that I'm actually in a team truck, and if I were running real team miles, I'm not. But if I was in a team truck, my truck would have about 500,000 miles on it right now for the length of time that I've had it. And then my value would only be $61,000. Maybe it was 67. I can't remember. It was pretty close to that. So from 91 to 137 is a $46,000 gap in what the market value, what the main insurance pays versus what the rest covers. right? And this is the magic pieces. So gap coverage has a cap of $20,000. And I mean, it's something that's built in the insurance world, whatever. Way too much for me, but whatever. So in the event of a catastrophic total, right? If I'm only getting paid market value, like what OIDA would pay on the insurance, they're only going to give me $91,000 for my truck. I still owe $46,000.
And you're left holding the bag.
Absolutely. And in the event that I had 500,000 miles on my truck, like I should have, that's another $30,000. So now I'm at $76,000 upside down that I still owe on that truck contractually. So where am I going to do that? How am I going to pay that? Right? I'm not. It's going to go to litigation and it's going to be crazy and whatever. No, and you're absolutely right. I leased my truck at absolutely the worst time in the market. But
Yeah, give you an idea. I leased a new truck a year later and got a much better deal.
yeah, right. But the fact remains that there's still that gap. I mean, we actually had a claim this past year, towards the end of the year, where the guy literally left the yard, had just signed for the truck, was on his way to pick up or had just picked up his first load, had 80 miles that he put on the truck, totaled the truck. And our insurance paid it. It sucked, but they paid it.
Now, here's the thing: is that right now with the market the way it is, trucks are dropping like cars are when you drive them off the lot. So his truck paper price, what was it? Sorry, like 170,
Right.
and the lease was for 220 or something
Right.
like that. So it's something to consider.
It was crazy.